Hello, friends. Welcome back. Today, let's talk about a company that has been making a lot of noise in the market, Anand Rathi Wealth Management Limited. Many of you must have thought, is this stock a good buy? Is it overvalued? So let's dive deep and understand this company together. Imagine you have a lot of money and you don't know where to invest it. You would probably hire an expert, right? That's exactly what Anand Rathi Wealth does. They are like financial doctors for high net worth individuals, or HNIs. These are people who have more than 5 crores to invest. The company helps them manage their wealth, suggesting where to put their money to make it grow. They focus on providing wealth management solutions, making them a specialized player in the financial services industry. So, how does Anand Rathi make money? It's quite simple. Their main business is helping these wealthy clients build their investment portfolios, manage their investment portfolios. They don't just give advice, they help execute the entire plan. Their revenue primarily comes from the fees they charge for these services. Think of it as a commission or a service charge for their expertise. This business model is interesting because as their clients' wealth grows, the company's revenue also tends to increase. They have a very client-centric approach, which means they try to build long-term relationships rather than just focusing on one-time transactions. This focus on HNIs makes their business quite niche and different from a regular stockbroker who serves all kinds of investors. Now, why has this company been in the limelight? Since its IPO in December 2021, the stock has given phenomenal returns, making many early investors very happy. The company has shown strong and consistent growth, which always catches the market's attention. As more and more people in India become wealthy, the demand for professional wealth management services is expected to rise. Anand Rathi is in a sweet spot to capture this growing market. Their focus on a specific high-value client segment has helped them build a strong brand reputation. People trust them with large sums of money, which is a big asset in the financial world. It's this combination of a solid business model and a growing market that has everyone talking. Let's quickly look at what this means for you as a potential investor. When you look at Anand Rathi, you are not looking at a bank or a typical financial company. You are looking at a specialized wealth manager. Their success is directly tied to the financial well-being of India's richest individuals and the overall health of the stock market. Understanding this core business is the first and most important step before we analyze its financials. Is the company truly as good as its stock performance suggests? Or is there something we are missing? Let's break down the good, the bad. So grab your cup of chai and let's get started. Now it's time to look at the other side of the coin, the bad side. The biggest and most obvious concern for Anand Rathi is its expensive stock price. Let's talk numbers. The stock is currently trading at a price-to-earnings ratio of over 100. To put this in perspective, the industry average price-to-earnings ratio for similar companies is much lower, typically around 30 to 40. A price-to-earnings of 100 means that investors are willing to pay 100 rupees for every 1 rupee of the company's annual earnings. This is a very, very high valuation. It suggests that the market has already factored in very high future growth for many years to come. If the company fails to meet these massive expectations, even by a small margin, the stock price could see a significant correction. Another point of concern is the reduction of the promoter's stake. The promoters, who are the founders and original owners of the company, have been gradually selling their shares. While there can be many personal reasons for promoters to sell their stake, it can sometimes be seen as a red flag by the market. When the insiders who know the company best are reducing their ownership, it can make retail investors nervous. It raises questions about whether they believe the stock is overvalued or if they see potential challenges ahead. This consistent selling, even if done in a planned manner, adds an element of uncertainty for new investors who are considering entering the stock at its current high price. Third, we cannot ignore the intense competition in the wealth management space. HDFC, ICICI, Kotak, IIFL Wealth, now called 361, Nuvama Wealth. These competitors are also very aggressive and have deep pockets. While Anand Rathi has carved out a niche for itself, the competitive pressure is always there. To maintain its high growth, it needs to constantly innovate and provide superior service, which is a continuous challenge in such a crowded market. Lastly, the company's fortunes are heavily dependent on the stock market's performance. Anand Rathi's revenue is linked to the value of the assets under management. When the market is booming, like it has been, their assets under management swell and their fee income increases. However, if there is a major market crash or a prolonged bear market, their assets under management would decrease, directly impacting their revenues and profits. This dependency on market cycles is a significant risk. For a company trading at such a high valuation, any downturn in the market could have a disproportionately large negative impact on its stock price. This cyclical nature of the business is something every investor must be aware of. Now let's move to the part I call the ugly truth vertical bar, where we discuss the most serious risks. The ugliest aspect here is the extreme overvaluation combined with market sentiment. A price to earnings of over 100 is not just high, it's in bubble territory. This valuation is pricing in perfection for the next 5 to 7 years. It implies growth of 30 to 35% assumed to continue without hiccups. What if there's a regulatory change, a market downturn, or a new competitor disrupts the space? The stock price is riding a wave of very positive sentiment. If sentiment shifts, the fall could be as sharp as the rise. That's a major capital loss risk for new entrants. Another smaller concern is working capital. The company is cash rich, but much is tied up in trade receivables. These are fees clients owe. Timely collection is crucial in wealth management. Any delay or default in these payments can strain cash flows, especially during a market downturn when clients face liquidity issues. Their track record is good, but this is an operational risk of the business model. Small details matter in finance. Efficient working capital management is key to sustaining high profitability. Consider the company's size. Anand Rathi is still relatively small versus industry giants. Assets under management are much smaller than 361 and the wealth divisions of large banks. Small and nimble growth has benefits, but it also means less cushion for shocks. In a sector where trust and scale matter, lack of scale can be a long-term disadvantage. This risk doesn't seem fully priced into the high valuation. Final thoughts? Anand Rathi is a great business with strong growth, profitability, and client focus. The good is very strong. The bad and the ugly revolve around one theme: the extremely high valuation. The stock appears to have priced in all positives, leaving little margin of safety. Long-term investors must ask if the company can sustain extraordinary growth to justify this premium. It may be prudent to wait for a market correction or better valuation. Traders can profit from momentum, but should be very cautious of volatility and sharp reversals. Not investment advice. Do your own research. Happy investing.